Good morning and welcome to the Orlando Real Estate Buzz. I'm Brenden Rendo with the Homes in Orlando team, and we got Joe back this week, trying to stay warm here in Florida. And wow, what a morning! We kind of got sidetracked of what we wanted to start out with because, like 10:30 this morning, the markets just kind of went berserk, huh?
Well, they went cold. They went cold fast.
I mean, I don't know if anyone's seen it yet, but we had the bond market go from 4.26 on the 10 to 4.23. We had gold dropping, $350 an ounce.
350, like 5% drop.
Yep.
A little bit more than that.
Yeah, the NASDAQ's all whacked. Bitcoin's got a 5% sell-off. Just absolutely crazy morning.
You don't see that usually. Usually one of those, you've got the crypto dropping, you've got the stock market dropping, you've got gold dropping. Usually one of those is climbing when the others are dropping.
Yep.
So to see everything kind of just take a big, a breath of it's got me going, okay, what's going to happen? And we were trying to search, what was the news? I couldn't find it.
Yep. I mean, the only thing that came out this morning was the trade deficit.
Mm-hmm.
And that went in the wrong direction. Took a huge jump to $59 billion.
From was it, 29 billion before?
Yeah, 29 billion. Yeah, it had dropped to one of the lowest levels since I think it was 2007, something like that. And then I don't know, maybe everybody was prepping for the ice storm that they had last week or something, because boy, did it shot the other direction, and it's just crazy.
Mm-hmm.
I know there's, listen to a lot of people out there. There's a lot of fear on the devaluation of the dollar right now, and I think it's gonna have a lot of effects. I think that's one reason why we're seeing gold shoot up tremendously, and you're just kind of looking at it, going, man, what's going on here? But you look at it, and this is a chart that recently came out, and I think this is one of the big concerns is we got central banks all over the world starting to sell off U.S. treasuries for the first time in years. I mean, since 1995, they're buying more gold, and their stock is more in gold than it is in U.S. treasuries.
Yeah, that's definitely an interesting. And you look at the map, you can see it peaked in, 2016, 2017, and it's a slow decline. But what I noticed is the treasuries has declined steadily, but there's been a sharp jump in gold. And I wonder if that's part of what's driving gold prices to increase as rapidly as we're seeing them, is because these central banks are buying at such a fast rate.
Yeah. To me, it shows a lack of confidence in the U.S. treasuries and in the U.S. government on an overall, which I can understand, because, I mean, we're approaching nearly a $40 trillion debt right now. And if you watching what's going on in Japan, their long-term they do 40 years. They don't do 30 years. They do 40-year bonds. That bond yield has jumped to almost 4% from nearly zero just a couple of years ago. And they're having a lot of economic issues right now. But you're seeing it all over the place, where I think a lot of people are just looking at the world's debt, every debt, and just saying this just isn't sustainable anymore. And they're running to the greatest safety that anyone's ever known, gold. It's the one currency that is super steady. And one of my concerns is that we're going to start seeing bond yields actually increase as opposed to decrease, because you've got to make them more attractive, you've got to increase the yields. And that's kind of a concern I've got. right now going into this year, a lot of people thought we'd be flat, but it's kind of scary. I mean, you look at the bond market today, boom, there we are, roughly, opening, we're sitting at almost 4.7, 4.27, excuse me. And, literally in about 10 minutes, we dropped to 4.225.
Mm-hmm.
And, we're starting to creep back up. But what people are saying is that it's just people are nervous because the dollar has hit its lowest value that it's seen in numerous years. So you're not sure which direction it's going to go. The one nice thing that we can see that's happened over the past couple months is when you look at this and then you look at what the 30 years mortgage is going at, which is what, roughly about 6.1, a little over that. Where are you sitting right now?
I mean, somewhere. I mean, it really, I think the book's for conventional, we're sitting in that 6 to 6.25, 6.375 is what we're seeing. But I've noticed that, over the last month to 2 months, we've seen the credit profile on conventional becoming increasingly important, right? Like there's times where the credit profile doesn't matter as much. Like it's always important on conventional. Mm-hmm. But I'm seeing bigger margins for, someone with a 680 to a 720, the rate's going to be different. Whereas it might have been just a little bit more cost. Now it might be a different rate. Does that make sense?
Oh, okay. So what you're saying is if you're at 680, they're feeling you're a little higher credit risk. So they're going to charge you a little bit more.
Yep.
Is that correct? Okay.
Yep, pretty much.
Okay. Yeah, because we look at it, and one thing we talked about a lot last year is that margin between the 10-year and what the 30-year conventional mortgages were going at, and we're sitting roughly about 2.5. So we've continued to see that squeeze, and I think that's one thing that's really kind of, quite honestly, helping the market right now, making it just a little more attractive. I think we saw the mortgage applications go up when we had that hour
pretty much
where we're actually below that 6% mark. Put a lot of enthusiasm behind a lot of buyers who are kind of waiting for that drop.
Yep.
To below 6. So it seems like that's going to be our threshold to try and get this market moving again. Is going to be that 6% market. So. Continue to watch that. Hopefully we can see that those margins squeeze back down to a little more normal, which is that, of course, at 1.5% rate.
Yeah.
But going back to, I think some of the original things we're going to talk about is of course we had the Fed meeting yesterday, and not a whole lot different than anything we've talked about. But I got to show you Jerome Powell's comment on housing. Now you got to listen close.
Let's listen. Come on, bring it to me.
All right.
Of monetary policy as appropriate to promote progress toward both our maximum employment and 2% inflation goals. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak.
There you go. That was it. 47 minutes of questions and answers and his speech. 47 minutes, 2 seconds spent on housing. That was it.
Housing's not important at all, though. Let's be fair.
That just goes to show you the amount of interest they have in the housing market, which is just absolutely amazing. They come out. He always says the same stupid thing. Our goal of maximum employment and 2% inflation. Says it every time he comes out. And as far as housing, who cares?
Okay. It's a really goal. I mean, what I mean, in a roundabout, what do we expect? Like,
Yep.
He's not made it that important. I feel like I feel like they're not really looking at the data very well. I think the only people that are looking beyond the numbers, in my mind, on the Fed members is Weller and Mirren. Like, they're able to see behind the smoke shop or the screen. Like, they were the ones that dissented from abstaining from or staying neutral. They wanted to see another 25 BIP cut.
Yep.
Powell was saying that even they still think they're above a neutral rate, but not taking action now. Like, I'm like, they say these things, but then they point to all these other areas, and it's kind of like they're just picking and choosing what to do, and they're looking and going, "Oh, this number says this," but they're not reading behind the what's making the number what it is.
Yeah. I mean, overall inflation, what was it? Averaged out to 3% for the year.
Mm-hmm.
So I understand. Okay, well, you don't want a super hot market. They're looking at GDP numbers from the past couple months, and that's that's really shot up according to the Atlanta Fed, over 5%. So the numbers they're using make it seem like it's the economy's too hot. But then when you go out and you talk to people, you're not feeling that. You're not feeling people are putting money in their pocket hand over fist.
Yeah.
With a 5% GDP, you think a lot of people will be like, man, things are good. I'm
great.
I can afford to buy a house, afford to buy a new car.
Yeah.
Things are looking great for the future. I don't know anyone feels like that right now. I mean,
it definitely, I definitely feel like there's a lot of uncertainty in everything on this. And you see the stuff with and I hate to say you see what Trump's doing, you see what he's a pistol, and sometimes it's going to be great, sometimes it's not going to be so good, and or it's going to be bad, right? And I think we're seeing that is we're very sensitive to all these moving pieces, and the market is very quick to react, to respond. You look at things where it's just it doesn't always move the way you think. The analytics don't matter as much as the emotion now, I feel like that's what
that really kind of gets into some of the things that have happened over the past month or so. According to Redfin's numbers that they came out with, a couple days ago, we had the largest number of cancellations in home purchase contracts in December of last year, roughly 40,000. Wow. And that came out to roughly 16.3% of home purchase contracts were canceled last year. That's a lot of cancellations.
Yeah.
And then here in Orlando, that number was roughly about 19.3%. So
basically one out of five contracts.
One out of five contracts was canceled. And I'm wondering, is that more just fear of what's happening? Is it that they did inspections, the houses weren't in good shape?
I feel like that's interesting because you mentioned the whole U.S. and I'm like, okay, well, maybe there's a lot of storms, there's snow or this and that. These are cancellations, not delays. And you mentioned Orlando's market being not in Florida, we have Homestead. I would expect December to be relatively low because people are going to try to lock in Homestead for property taxes.
Yeah, very, very true. And I'm just, I know there's some that you look at, and when you look at their record of the house, when someone's going to look at them, and you see that it's been canceled 2 or 3 times, and it's usually canceled within that home inspection period. So in those cases, I kind of look at them and go, okay, yeah, they found something in the home inspection, it's shown up a couple times, and the seller's just not willing to fix it.
Yeah,
but that's just not the feeling that you're getting. And then the other thing that you're seeing is, the number of sellers is so much higher than the number of buyers on the market right now.
Mm-hmm.
According to Redfin, there's roughly about 47% more sellers than there are buyers on the market. So, there's another situation where, we saw the number of cancellations last year, which were the highest in history of listings. But that just, as a seller, that's got to make you a little bit nervous. And from a listing standpoint, you've got to approach things, I think, completely different than when we had it down here in 2021, where you had 40% more buyers. One thing I'm doing now with my sellers is we are doing pre-listing inspections, making sure that we are hitting everything that they can object on. I've got a new listing coming live in Apopka, and we went through it, and okay, we got a couple. Neither one of us realized this, I or the seller, is someone shot a BB into one of his windows. And we're like, oh man, so here's a window we need to get fixed that would have shown up on the home inspection, right?
Yeah.
And then you look at the AC unit, and his AC unit's 20 years old. He had a home warranty on it. They replaced the guts of it. So in a sense, I think he had it done about 3 years ago. It's relatively new. But what happens is when a home inspector looks at it, he's going to look at the sticker on the unit and see that it was built in 2025, and he's going to recommend that it be replaced. So we're having to address that. But what we're trying to do is present a very clean house, and that's what sellers have to look at. You got to have a clean house, and boy, don't try and overprice it. Don't push the ceiling. I actually showed a client, actually one of Warren's clients, while I was out of town for him, and we looked at a house in Winter Park, that great location, right by the little golf course there off of Ranger.
Yeah,
and was priced right, $475, and they actually ended up with multiple offers because they priced it right, priced it aggressively, priced it right. You went in, the house was clean, wasn't really, there were things that needed to be updated, but in that area at $475, you're like, wow, that's great. That's fantastic, overall for the value. And then the other thing I found interesting is Bank of America came out with some numbers of where people are moving to and moving from. And a lot of people always say, oh, Orlando's growing. People are moving to Orlando. But according to Bank of America's number, Orlando's population's down a little bit. So we're not getting the people moving here like we did. And I think a lot of that is, I've talked to several people from New York, from Pennsylvania, and right now they're not feeling that we're the affordable place anymore, like we used to be.
Yeah.
They used to feel like, 10 years ago, oh my gosh, I can come down to Florida and get so much more house for what I'm getting up in, Long Island, Bronx, any place like that, going up through Westchester. I can sell my house for $800,000, $850,000 up here, and come down, buy a $300,000, $400,000 house and live large. Not the same story anymore between home price increases, insurance increases, tax increases. Those opportunities that people saw just aren't here. And with our temperatures hitting, we're supposed to hit like 20 something on Sunday. Oh, may not be the weather.
That's just for a night. Try being somewhere else.
Yeah, this is our 2 weeks of winter that we get every year. So
there you go. It happens. It's not even going to snow. It's great. Wind chill is still in the positives. Can't say that about New York and all these other places. They see negative wind chill every year.
Yes.
Not us. Not us.
I don't miss it. I do not miss it.
But and you mentioned this, like when we talk about transplants and stuff, our company, my company's like, we're licensed in a number of states, but some of the states that we see, and I feel like we've seen the conversation shift more too, is, Texas and Tennessee. I see a lot of people relocating to those states and a lot more conversations happening in those states. And that's just two of them. Like, we still see it a lot in Orlando and Florida because that's the bulk of our business. But I've noticed in our company an uptick of relocations to states like Tennessee that has lower prices, lower insurance, no state income tax. They're it's a little bit farther south, still gets cold, but the affordability is so high that a lot of people are looking at it where they might not have a decade ago.
Yeah. I think, I know Florida really kind of has lost that affordability draw that we used to have. It's just not there anymore. Well, let's hop into our numbers for the week here in Orlando, and it was a cold week, very cold. Our single family home sales dropped to 279, which that's low. That's low. And here's something that's interesting: is the median price of the single family homes dropped to 392.5. That's the first time, I think, in over a year that we've seen that price drop below $400,000.
Wow.
So I found that extremely interesting. Inventory starting to come back up, which we knew it would. A lot of people wait until after the holidays, put houses back on the market. Then our condos just doldrums, 77. Their inventory is going back up. Then we look at our months of inventory, because the number of sales dropped so much. Our months of inventory is actually increased to roughly about 7 months of inventory. And again, going back to old school, you got over 6 months, buyer's market, definitely a buyer's market. Then our original list to sales price sitting roughly about 93%. On the high end, those $1 million homes, they don't think they've broken above 92 in 2 or 3 months now, something like that. And then average days on market, 73. But look at this, between the 250 and 300,000, which most people can still afford. Average days on market is only 49 days. That tells me there's the window. If there's some way we could make houses were priced in that range, we've got buyers for it, because they're selling so much quicker than the others. Then you look at your weekly sales, and you see our average has dropped to 360. Last year, we're averaging close to 400, 410 per week was about the average where we were. And inventory, here we go. We're starting to creep back up, which again is going to help buyers further. That's not a bad increase, about 5.5% for the beginning of the year. Break into our condos. Year supply in condos.
Yeah.
A year. Oh. I'm actually surprised that the original list to sales price is sitting roughly about 92.5%. I thought this would probably go a little bit lower, but it could be they're starting to price them a lot better than they used to.
That's true. It could be. Or they just have the floor. The condo market's always a weird one for me, because I feel like there's a lot of money to be made on the condo side, or there was. And I do feel like it takes the right, and I wonder, it takes the right buyer.
Yeah.
If that makes sense. You know what I mean?
Yeah. Yeah. It's when you start looking at the HOA fees now, where you went from maybe 100, 150 in a lot of places up to $400 or $450. That's a lot of house. But then you got to look at the cost of maintaining your house. Where it used to be, that's the way I used to explain to a lot of people, hey, if your HOA is $150, what about, let's count lawn maintenance. If you got a pool, the pool maintenance, exterior maintenance. does that $150 make sense? And a lot of people say, oh yeah, it does. Now it's like 450. Not so sure it makes as much sense as it used to. And I think a lot of people are just afraid that it's not going to stop. I think that's the biggest fear. But the past year, I haven't seen the increases that we saw, once we had the collapse of that, and they changed the laws with that one condo in the South.
It definitely created some recalibration. I think those new laws were probably needed. They probably needed to be on the books. Let's be fair.
Yeah.
Right. And I think it's going to take a little bit of a cycle, but I think once it resets the tone, like people are going to it's going to bring that all right, now condos are more stable than ever. But it is very interesting because we talked, we just had one of a buyer, one of the associates at my company, the condo community said, we're not doing a questionnaire. We refuse. And we were like, wait, what? You have to. And they're like, no, our board voted. We're not providing questionnaires or any documentation to lenders.
Wow.
So we had to go back to the buyer and be like, hey, this community has basically said that they don't want people with mortgages. And it's their choice, right? It's their choice.
Yeah. I mean, that's the kind of choice.
It was very interesting to see. I was you get a little bit do you understand what you're doing here? But also hey, you got a property management firm. If you guys went that direction,
there's nothing you can do. I mean, it's been bad enough. The past 10 years since the Great Recession. Try and find a condo community that was approved FHA. I mean,
it's a handful of them.
Yeah. It was like a needle in a haystack trying to find one. And, now you're going to say you're not going to allow any mortgages. I mean, you've got to, the money down on condos is generally a little bit higher too. Is it, do they still?
I mean, you can still get by you get 3%. There's still unconventional 3% and so forth. But and this was a decision for an individual community. I don't want to say it's widespread, but it was just very interesting to be hey, we can't do a loan. It's not on an approved list. It's not here. We don't have this. And they refused. They've said and told us in writing that they refuse to provide any documentation, that it's against their policy. Jeez. And the board voted to take this stance. And we're like, okay, well, that's our answer. So the buyer was like, but I like the place. And we're like, sorry,
nothing we can do.
You can't do anything.
Unless you can get this, hopefully maybe the seller owns it free and clear.
Owner financing. I don't know. Yeah. But if you're going to owner finance, you're going to want more. Yeah. That's a whole different ballgame.
Yeah. Wow. That's nuts. Didn't realize that. Okay. Well, that is our market. It's going to be, I think, interesting for maybe the next couple of days or so, especially with what happened this morning. Wish had a better explanation for everybody, but really kind of got caught off guard. What's that?
Let's see if there's another government shutdown. Isn't there a partial shutdown on the table right now?
I don't know, but boy, kind of caught me off guard sitting here getting ready this morning. So I just want to say thank you, everyone, for joining us. Please come back, join us every week. We're here on Thursdays at 11. And thank you for visiting the Orlando Real Estate Buzz. Take care, Joe. We'll see you next week. Bye-bye.